If you're running a $2 to $10 million agency, there's a good chance your business is worth less than you think. And in the next few minutes, I'm gonna show you exactly why and what to fix. I'm gonna walk you through the exact 45-minute workshop we run with agency founders to figure out what their business is actually worth, and more importantly, what's holding the value back. This is a real session, and I've changed the names and some details, but the numbers, the conversation, the way we diagnose the constraint, that's all real. And by the end of this, you're gonna see exactly how one shift, one constraint, identified and solved in the right order can move enterprise value millions of dollars. So let's get into it. So here's what we're gonna walk through today. The scorecard we use to value your agency, how great CEOs think about constraints, the 6 value drivers, the 5 risks that crush multiples, and finally, a before and after valuation on a real $3 million agency. Under 2 million, you should just focus on revenue. From 2 million to 5 million on health, from 5 million to 10 million on risk. Most founders mix those up and it stalls their valuation. This is the scorecard we use, and I'm gonna fill it out live as we go. These are the 3 sections, and the order matters. Top, baseline value, revenue and EBITDA. This is what makes the business interesting. If you're under about 2 million, this is the whole game. Get revenue up and make sure there's profit left over. Don't overcomplicate it. The middle are the value adders, the revenue growth, the retention, the margins, and lifetime gross profit to customer acquisition costs. This is how healthy the business is. Between about 2 and 5 million, this is where your energy should go. The bottom is risk. Key person risk, key client risk, single channel risk, market and data risk. These are what make the business sellable. They matter a lot more once you're past the 5 million and buyers start actually looking at you. Unaddressed risks crush your multiple. So the sequence is get interesting, get healthy, get sellable, and in that order. Your agency's value is just EBITDA times a multiple, and this is the scorecard on how we move that multiple from 1 to 2x towards 5 to 6x. And here's the math how it works. We take your EBITDA and apply a base multiple based on how big that EBITDA is, and then adjust that multiple up or down based on the value adders and the risks. This gives us a valuation range. Not a formal valuation for legal purposes, but it's extremely useful to seeing where you should focus and in what sequence. Great CEOs don't try to fix everything at once. They find the single constraint holding the business back and throw all their resources at it. So before we fill in the numbers, I want to talk about how the best CEOs decide where to invest their time, money, and effort. Constraint theory is simple. Identify the bottleneck, allocate your EBITDA time and effort into solving it, and then unlock growth. And then repeat that on the next constraint. That's really what great CEOs do. They solve the right bottleneck in the right order over and over. The most dangerous place to be is solving the wrong problem really well. This 2x2 framework shows you exactly where you're wasting your time. There are 4 ways you could be spending your time in the business. You could be doing the right problem the wrong way. You know your pricing is the issue, but you guess at new margins instead of talking to clients about the value and looking at the data. The wrong problem the wrong way, and now that's just chaos. Or you could be doing the wrong problem the right way, and this is the dangerous one. You're executing well, you have a plan, but it's the wrong problem. It feels productive, but it doesn't move the business. The right problem the right way, this is where all the returns are. So the whole point of this workshop is really to get you into that last quadrant, solving the right problem the right way for your specific business. A business grows to its constraint. Every agency grows until it hits a constraint and then it flatlines. If you've been stuck at the same revenue for a year, this is why. Across 50+ agencies, the pattern is the same. The ones that break through and find the real bottleneck throw resources at it and then move on. The ones that stay stuck either solve the wrong problem really well or the right one with the wrong approach. This is why we do this workshop, so you walk away knowing what that one constraint is and what to do about it. The agency we're going to look at today, I'll call them Pinnacle, is a specialized B2B agency doing about 3 million in revenue. 2 co-founders basically run everything. Team of about 15 people. Growth has been mostly referral based, almost entirely word of mouth and reputation. They came to us wanting to get to about 5 million in revenue in 3 to 5 years, and they were starting to think about what the business would be worth if they ever wanted to sell. But they had never looked at their numbers through that lens before. So let's fill in the scorecard. There are 6 numbers that make your agency more valuable. Revenue, revenue growth, EBITDA, EBITDA margin, revenue retention, and lifetime gross profit to customer acquisition cost. You can track 100 other metrics, but we keep it at these 6 because they move the valuation the most. Money coming in is revenue, and it's simple. There's 3 ways to grow it. You either get more customers, you charge more, or you get them to buy more often. And most agencies are doing none of these 3 on purpose. Pinnacle is sitting at about 3.1 million in trailing 12 months revenue, and so I'm gonna plug that in. Year over year, growing at 30% can add a full point to your valuation multiple. Crawling along at 10 to 15% usually adds nothing. So when we compare the last 12 months to the previous 12, Pinnacle here is at 13% year over year. And that's decent, but a business growing 30 to 100% a year can get a whole bonus point added to the scorecard. Over 100%, you get 2 points. 13% doesn't get us there, and when I asked them about how they plan to grow, it was basically do more of what they've already been doing. More referrals, maybe a conference, improve the website, no real paid acquisition, no outbound system, no scalable demand engine. So there's a ceiling to how fast they can grow with their current approach. EBITDA is the money left over to reinvest into your agency. If it's under 30%, you're basically working for your clients, not yourself. Now here's where it gets interesting. On the surface, their income statement looks fine, but when we normalize the founders' salaries, meaning what would you have to pay someone to do what the founders are actually doing in the business, their EBITDA margin drops to about 15% because they paid themselves through dividends, and dividends don't show up on your income statement. So now after a 15% normalized salary, and I mean, it's not bad, there's no budget for their marketing, and if they want to grow faster, they need to invest into that marketing and more overhead as the business gets more complex. So at 15% margins, there's just no room. So this kept pointing back to one thing, which is pricing. They were pricing based on estimated hours times an hourly rate, the classic bottom-up approach. And this is the problem. You end up capping your upsides. You're basically saying the most I can charge is the hours that I can bill. But when I asked about their close rates, and this was the moment one of the founders says, I think when someone comes to us, it's like a 90% close rate. So think about that from a supply and demand standpoint. If you have way more demand than you can actually serve and almost everyone says yes, that's the single biggest sign that you could raise your price, like significantly. You could probably test doubling your price and see your close rates drop to 50%, and you'd still be making more money on fewer projects with better margins. That's where the constraint was really hiding. Retention, how many people still buy? If your revenue retention is under 80%, your valuation is quietly bleeding out, even if the top line looks fine. They hadn't formally tracked retention, but their clients tend to come back. It's a relationship-driven business, so we estimated above 80% and flagged it as something to start measuring. A master client list with start dates and end dates and lifetime spend. Lifetime gross profit to customer acquisition cost is the single most important ratio in your agency. If you don't know it, you're flying blind. There are only 2 ways to make your business more valuable. Improve this ratio by making clients worth more relative to what it costs to get them, or reduce risk. Everything else is a subset of those 2. And right now, Pinnacle isn't spending much on marketing at all, so customer acquisition cost was basically 0. It's all referrals. So the ratio looks amazing on paper, but the moment that they start investing into paid acquisition, outbound, or conferences, that number will change. So we need enough gross profit per client to support that investment, which brings us also back to pricing. Until you know exactly where leads are dropping between click and close, every marketing dollar you spend is just an educated guess. To get more customers and bring customer acquisition costs down, we need to look at the whole pipeline. Your advertising, the creative, the messaging, the targeting, the platform, lead magnets, engaging. Are people booking calls? Are you following up? Qualify, are they showing up? Are we making offers? And then closing, what do your scripts, training, and incentives look like? Pinnacle was doing almost none of this in a structured way. Some LinkedIn posts, a conference once a year, no funnel, no tracking, no attribution. When I asked where they thought the bottleneck was, they said they honestly didn't know because they weren't tracking anything, which is very common. The fastest way to grow your enterprise value isn't always more clients. It's making each good client worth dramatically more over their lifetime. The other side of this equation is making each client worth more. Can we make the product easier, faster, better? Can we price it appropriately? What does onboarding look like? How fast do clients get value? Are we collecting testimonials and case studies? Are there upsells? Are we reselling and retaining our clients over time? For Pinnacle, a big unlock was starting to work with clients earlier in their product lifecycle, 2 to 3 years before they launched their products, instead of just at the end. Those longer engagements had much higher lifetime gross profit. If they shifted their positioning to attract more of those early stage clients, revenue per client goes up dramatically, and that changes the whole game, the whole economics of the business. There are 5 risk factors that crush your multiple, and most $2 to $10 million agencies carry at least 3 of these right now. Now the not so fun stuff, the things that make a business less valuable. And like I said earlier, you want to focus on getting the business healthy first and then tackle these. So you're not going to eliminate key person risk while you're still building the thing, but they are real and every buyer will care about every single one of these. If your agency can't sell, deliver, market without you, a buyer will discount your valuation more than you think. Does the business need the founders to function? And for Pinnacle, absolutely yes. Both co-founders were deeply embedded in delivery, sales, and client relationships. So if a buyer came in tomorrow, the business would shrink, and that's key person risk. On the scorecard, this was the heaviest penalty, 3 points off the multiple. That's huge. One key client, one single channel, or one spreadsheet-only finance system can turn a good agency into a terrifying bet for a buyer. Key client risk. No single client was over 20% of revenue. Good. Diversification. No deduction. Single channel risk. Almost everything came from referrals and reputation. That's one channel. If referrals slow down, there's no backup. -1 point. Market risk. Their industry wasn't shrinking. Some regulatory headwinds, but demand overall is up. No deduction. Data risk. Clean financial statements, which is great, but no systematic tracking of sales metrics, marketing attribution, client retention, or project level profitability. They were tracking for compliance, not for decisions, and that's data risk, -1 point. The whole game is simple. Grow EBITDA, then earn a better multiple on that EBITDA. This is the formula we're working backwards from. To maximize enterprise value, we take EBITDA times a multiple, and that equals the value of your business today. So you can see just how much the base multiple jumps once you cross that 1 million in EBITDA threshold. That's why getting to 1 million in profit is so important. The multiple itself changes. If you try to fix 5 things at once, you fix nothing. So here we narrow it down to the one domino that moves everything else. After going through the scorecard, I asked them, based on everything we talked about, what's the one thing you should focus on first? And both founders said pricing. I agreed. Margins were too thin to fund marketing. Without marketing, they can't grow faster than referrals. And without growth and reduced key person risk, the valuation stays compressed. To address key person risk, you need money. And to get money, you need better margins. To get better margins, you need to fix pricing. So pricing is the unlock, step 1. And that's constraint theory in practice. You don't try to solve 5 things at once. You find the one domino that tips everything else over. If you've been staring at the same problem for 2 quarters, you don't have a what problem, you have a who problem. And once we know the constraint, the next question is who's going to own solving it. The founders had been running everything. That's why pricing hadn't been addressed. They didn't have the bandwidth, too busy delivering to step in and fix the broken economics. And I see this pattern over and over. The founder knows the problem, they just don't have the time or system to solve it. So it sits there quarter after quarter. Everything you do falls into one of these 3 buckets. Get more customers, make customers worth more, or decrease risk. And you can approach each by doing more, doing it better, or trying something new. But if you've been staring at the same constraint for 2 quarters in a row, it's not a what or a how problem anymore, it's a who problem. You need someone designated to own it and drive it going forward. Before and after, the valuation lift. Here's what this $3 million agency is actually worth today and what it could be worth in 3 years if they fix the one constraint in the right order. So here's where Pinnacle sat when we filled out the scorecard. Revenue, 3.1 million. EBITDA after normalization, 465K. Key person risk high, single channel risk high, data risk present. The adjusted multiple came out pretty compressed. This is usually the part of the call where the founders get quiet because they know the number is lower than they expected. But that's the point. It's not meant to be depressing. It's meant to show you exactly what to focus on. Now watch what happens when we project 3 to 5 years out. Revenue grows to 5 million. EBITDA margin moves from 15% to 20%, which is 1 million in EBITDA, and that alone changes the base multiple. Growth at 30%, retention above 80%, LTGP to CAC tracked and above 10 to 1, and on the risk side, key person risk is down by building the management layer, acquisition channels are diversified, real dashboards for sales and marketing data, enterprise value moves from compressed to something more in the 4 to 6 million range. With a strategic buyer who values the team data relationships, it could even go much higher. And look at the sequence. Pricing first to unlock margins. Margins fund marketing and hires. Marketing diversifies channels and drives growth. Hires reduce key person risk. Each one sets up the next. This is what a buyer-ready agency actually looks like. 1 million plus EBITDA, 30% growth rates, 80% retention, healthy LTGP to CAC, low key person and client risk. How close are you to this checklist? If you were to sell your company, this is the checklist we want to button up over the next 3 to 5 years. Sufficient revenue to get 1 million plus in EBITDA, 30% growth, 80% revenue retention, strong margins, healthy LTGP to CAC, 10 to 1 for a service business, a leadership team in place, diverse customers, multiple acquisition channels, clean decision-ready data. That's the target state. You don't do all of it at once. You attack it in sequence, constraint by constraint. So that's the workshop. 45 minutes, one scorecard, one constraint identified, and a clear sequence for how we build enterprise value over the next 3 to 5 years. So if you run a marketing agency doing 2 to 10 million and you want us to run this for your business, we do it for free. It's called the Agency Profit Benchmark and Valuation Workshop. There's a link to click below if you want to apply. And if you found this useful, subscribe. I'm going to keep doing more of these, real numbers, real agencies, real constraints. Thanks for watching.